Let's get high. Dividends, that is. In this video, we're covering what you need to know about high dividend stocks, data-driven proof that shows that this can beat the market, and the 3 different dividend strategies that you can do. Now, I do want to preface this by saying that dividends and stock prices do change over time, so do your own research. I consider high yield dividends and stocks to be anything over 7%. Most dividend stocks fall under 2 to 3%. I don't think that high yield stocks are right for everyone, but in a tactical trading situation, it could potentially yield higher results than just going with a regular dividend stock or a regular index fund. Especially right now when we have a downtrending market and some of these high yield dividend stocks and ETFs have over a 10% yield, which definitely beats the market and beats a lot of savings rate. Normally, many high yield dividend stocks are a trap. They could be a company that is losing a lot of money, and so they're paying shareholders more income from their balance sheet or income that they're producing than they can actually afford to in the long run. Many of those dividend stocks will cut their dividend and you will not be a happy shareholder. Typically, you want to have a dividend stock that is increasing their dividend over time. They have paid out their dividend for many years. They have a low payout ratio and so on and so forth. Most high yield stocks do not have that. However, there are some high yield stocks that have those qualities if you look hard enough. And there are even some situations where you can invest into a certain index fund and it doesn't actually matter how the company fundamentals do. You can still generate a lot of passive income through it. But more on that later. We're going to start with the first of 3 high yield dividend investments, and that's going to be individual high yield stocks. Some of the ones that I like in particular are HTGC, ARCC, and IEP. HTGC and ARCC are business development finance companies, while IEP is run by the billionaire Carl Icahn. These all have a 10% yield, and they have been paying those consistently, actually, contrary to most people's conception of these high yield stocks for many years. In the case of IEP, for example, it pays at about a 15% yield, and it's increased that yield over the past 5+ years. And as you can see, they all have decently stable stock prices too. Now, as I mentioned at the beginning of this video, I'm going to prove to you with a particular strategy, some of these high yield dividend stocks can in fact beat the market. Now, for the purposes of proving that these high yield dividends can work in certain strategies, I'm going to be using the website Composer. This is a great platform that lets you backtest custom trading strategies that you can build using algorithm logic. Not sponsored, but I'd appreciate it. Now, as you can see here, I set up an if statement here with my strategy. So my thinking is during a downtrend in the market, potentially a bear market, it could be a good idea to buy into high yield dividend stocks. Now, generally when the stock market is going up, the 50-day moving average is a good indicator of how the trend is going. So if the 50-day moving average, the red line here, is above the yellow line, the 200-day moving average, then we are probably in an uptrend and the stock market is going higher. But once those moving averages cross, as you can see right here in 2022, that is usually a sign of a further downtrend to come, and we've seen a continued downtrend in the S&P 500 through 2022 and still into 2023. So I could use that in my if statement to set up a potential strategy of investment here. So I'm going to say that with the condition, if the 200-day moving average of SPY is greater than the 50-day moving average of SPY, then if that is the case, I am going to buy into these 3 high yield stocks. If this condition is not true though, then I'm not going to be in these 3 high yield stocks. I'm going to be in a safer, regular dividend ETF. So if we run that simulation from 2016 to 2023, what we'll see is that in times, this strategy actually outperforms the S&P 500. As you can see from 2016 to early 2017, this outperformed. You see a bit of outperformance here in 2019. And then if you zoom in here, if you look more in a closer time frame, let's say 2022, right, with that downtrend in the market, you can actually see that this symphony has outperformed the market for the past year. Outperformed, beat the market. And this is with dividends reinvested, by the way. It is a bit more nuanced than just looking at the performance, because if you look at returns, you might say this return is higher. That means this strategy is better, but it's not necessarily better for everyone. And there is more risk actually with these particular stocks in this strategy. Because if you look at the maximum drawdown, this statistic tells you the greatest drawdown from the peak of a stock price or the peak of this portfolio to a low. So from high to low, maximum drawdown is 46%. Whereas with SPY, there is a smaller drawdown. What does that mean? It just means that if you invest in a conventional ETF like SPY, there is less volatility than if you were to invest in high yield dividend stocks. If you were to compare this with just SPYD as well. So let's say instead of jumping in and out between SPYD and these three high yield stocks, why not just hold SPYD? Does that beat the market? Well, actually it doesn't. As you can see here, SPY is beating SPYD. So it does show that there is actual impact. It's actually creating alpha. It's actually making a difference to the portfolio. It's creating more returns. By the way, if you do want all of my trading and investing alerts in real time, as well as my team of analysts, make sure to check out the Stock Dads Discord. In our community, you get real-time alerts on all the trades that we make, and they're suitable for all types of traders and investors, short-term day traders, swing traders, long-term investments. We also have crypto and sports betting. In addition, we have a one-on-one mentorship program that was nationally recognized. Check out the link in the description or stockdads.com. A second and very popular method of doing high yield investments is using covered call ETFs like QYLD, XYLD, RYLD. And these index funds generate income not from the company fundamentals, as I alluded to earlier, but rather through call options. So they sell call options on their positions and in return collect premium, and then they distribute that premium to shareholders. Currently, these all pay about a 13% dividend. So for these covered calls, let's go over this backtest simulation once again as well. Now in this case, because not all of these ETFs have had a long lifetime, some of these were created only a couple of years ago, we can only run this simulation from 2019. But with that being said, in this particular case, you can see that this symphony actually underperforms the S&P 500. 39% gain thus far for the S&P, while this portfolio only 12% gain. So doesn't look particularly good. But once again, let's look at it from a bit of a nuanced standpoint. So we're going to look at it in a definite bear market. So January 2022 to year to date, let's see how this portfolio has performed. And it turns out it's actually better. At the moment, it is slightly beating the market here. This symphony has a negative 10% from 2022 to present, whereas SPY is down about 12%. Lastly, there are other income index funds like JEPI, JEPI, HYT, NRA, and these generate income through other means. So for example, some of these generate income through high yield corporate bonds, otherwise known as junk bonds. So our final backtest here, and we're gonna do JEPI, HYT, and RA, else SPYD. So again, we're getting into these when there is a market downturn. And what we find here is very, very, very interesting. So again, because JEPI was created in 2020, I can only backtest from 2020, but it's still a pretty interesting backtest because we're looking at how the market performed out of the pandemic bottom, right? And the whole market surged like crazy. Going into the new year here, around 2021 is when this portfolio really picks up. And it outperforms massively. At a high, this was about a 70% gain here versus SPY's 50% gain. Present day, this one is still outperforming SPY with a delta of about 26 percentage points there. So that is a big difference. So if you invest into these three stocks when the market hits a downturn, that seems to create quite a big performance gain. Very interestingly here now, you also have maximum drawdown is less than SPY. So you're taking effectively less risk to get more of a return. That's kind of mind-blowing. Whether that proves to be true over a long period of time, of course, we don't know. Everything here with this historical past performance is just that. It could help inform a decision, but it is the past, it's not the future. So overall, what can we conclude from those backtests? Well, it definitely looks like if you invest into high yield index funds or stocks at certain points in time in the market, that can help your portfolio beat the overall stock market performance. In my particular example with my strategy, buying into high yield when the market is down for an extended period of time, and then switching back into a regular index fund when the market is uptrending, this strategy outperforms simply investing into an index fund for whether the market's going up or down. That's it for me, guys. Hope you got a lot of value out of this one, some stocks to research, some strategies to think about, and maybe it changed your perspective on high yield dividend stocks and index funds. Leave a comment down below. I'm curious what dividend stocks you're investing in. Subscribe to Stock Dads if you haven't already, and I'll see you in the next video.